We continue to see this resurgence of virus cases around the world. So I got to ask, how long do you expect to remain resilient? The last time you said the business momentum has improved, wealth management, you saw a pickup in credit card spending, but for how long?
Well, you've got to realize that there is, frankly, a bifurcated situation with the virus as we speak, because most of the countries in East Asia are actually doing okay. You've not seen a massive resurgence of the virus in most North Asian countries, certainly not where we have a footprint. And as a consequence, you're beginning to see activity pick up. It started picking up into the third quarter, and it's continued to stay strong. So people are out spending. You can't get a restaurant booking anywhere. The only thing that's still flagging is the cross-border business. So travel is slow, but even there, with the air bubbles now coming up slowly, I think you will see a pickup. So our view on how bad things get has not changed over the last 6 months. We made an estimate early in the year on the kinds of companies and industries which are likely to be more vulnerable: tourism, hospitality, retail, etc. And frankly, that has not changed materially from the beginning of the year to now.
But you're also growing your footprint in, say, India, which hasn't really done well reining in the pandemic. You're taking over a failed bank, Lakshmi Vilas Bank. Why are you doing this now? Such a debt-saddled Indian bank. Did the RBI approach you for this? How did this come to be?
Actually, I'm not in a position to talk about that trade at this time till that transaction is approved. So I'd rather not take questions on that.
But what are your plans for the Indian market, though, Piyush?
Sorry, I didn't get that. I had
What are your plans for India? Because you're taking over this bank, which has failed, obviously. So what is the broader picture here?
So our plans for India have been consistent. We're a big believer that in the emerging markets, you need to go through cycle, and you've got to play the long game. We believe that the three big countries that matter for DBS's future in the region are China, India, and Indonesia. And in each of these countries, we're committed to continue to expand in whatever meaningful and sensible way we can. Now, the bulk of our expansion is organic and is driven through a digital and electronic banking strategy. But we found it beneficial in all the markets to be able to bolt on where we get a good opportunity to bolt on. We did that with the ANZ assets in Indonesia previously, and with the RBS assets in China sometime that. So a judicious mix of continuing to grow digitally, but recognizing that a physical presence, I call it a phygital strategy, is helpful, continues to be what guides us.
So do you see DBS India as a listed entity, and do you see it having an impact on DBS's dividend payout?
No, DBS India is not a listed entity. It's a wholly owned subsidiary, and it will continue to stay a wholly owned subsidiary. It is locally incorporated, which is what gives it the capacity to be able to do deals of this sort in the country. And no, I mean, if you look at the scale of the deal, it is very small in the big scheme of things. So it is not material to our dividend or our balance sheet at the group level.
You also recently received regulatory approval to set up a JV securities firm in China. Can you tell us about who you're potentially partnering up with, what your plans are for that business in that market?
Well, we got an application which is in the final stages of approval. We are partnering up with a couple of local partners. They're actually, one of them is a client of ours. Our plans for China actually are, like I said some time ago, we're very bullish on trying to grow in the big countries in our region. And China is without doubt the head of that list. So our plans in China are really to continue to scale in multiple kinds of ways. So the security joint venture is actually the only place outside major markets in Singapore and Hong Kong where we're keen to explore being part of the capital market in a meaningful way. Now, the Chinese capital market, as you know, is nascent, is just developing. And so we think there's an opportunity to build out that. But that's not all. We're also focused on continuing to build our presence in the Greater Bay Area. It's been a good business for us. Momentum is good. We're deeply integrated now into the supply chains coming out of there. We are looking at expanding in the consumer finance space. We already have a small entity. We have a small stake in an entity with the Postal Savings Bank, but we're looking at seeing how we can scale up that business as well. Outside of that, working with Chinese companies as they expand overseas continues to be the mainstay of our Chinese strategy.
You're also expanding when it comes to the crypto world. You are going to set up a digital exchange in Singapore. Tell us a little bit more about your plan. How does this make sense for you in your banking business?
Once again, this is work in process. We don't have any regulatory approvals for this at this point in time, so I'd rather not comment on it.
Piyush, I wanted to ask you about your views on what's happened to Ant Financial, right? The regulatory dressing down, the pushback of the IPO, the changing regulatory landscape in China and more broadly in Asia. What are your thoughts on this? Does it make you want to be more conservative when it comes to tying up in some of this, the fintech-related space, particularly in China, but also with the digital push in Singapore as well?
Actually, not at all. To me, the fact that over time, you will start getting a more level playing field, and therefore you'll start getting a proportionate and even regulatory response to all participants in the market, whether they're technology companies or banks. But that's been on the cards, and frankly, from our standpoint, that's welcome. Our view has been in the past that many technology companies have been able to benefit from the arbitrage of not having the same regulatory regime and supervision overhead that banks do. And so as we get to that stage, that's actually helpful to us. I also believe it's helpful for the development of the market and for the consumers at large. The thing that's happened in other industries, predatory pricing, which allows hollowing out of markets and monopolistic positions, I don't think that's sensible for the financial services industry. I think it creates too much risk and possibility of financial system instability. And therefore, trying to build the guardrails sensibly, trying to make sure that you don't wind up in a situation which encourages oligopolistic or monopolistic outcomes is actually a good thing.
So how battle ready are you in order to compete with these new companies now coming into your field, even though you're saying that potentially a level playing field is on the cards and that's much better, but how battle ready, how competitive are you with them, against them?
Well, we've been at this game ourselves for the last 7, 8 years. I maintained for a long time, there's nothing about technology which makes it in the purview of only a few people. Anybody can leverage technology. And so there is no reason why an incumbent bank like ourselves cannot create the same kind of capabilities and customer experiences that a tech company can. So in truth, we believe that we are fairly well advanced. The fact that we've been recognized as the world's best digital bank now on a few occasions, in fact, the world's best bank, is testimony to the fact that our customer experience, our customer products, our capacity to use data, digital, etc., is fairly well developed. So I would like to say, competition is always a challenge. So it doesn't matter whether it's a new technology player or another incumbent bank. We've just got to keep adapting to new competition. But I would also say that where we are today in our core markets, we're reasonably confident that we have what it takes to compete.
We're seeing adaptation and change as being necessary in the workforce as well. You recently announced this week that you'd let employees to work remotely up to 40% of the time, including a job sharing role or a scheme as well. My question then goes to office space, right? Do you need all that office space at MBFC, for example? Do you envision needing to keep that physical presence?
I think the office space of the future will be somewhat different, and I think the footprint will be smaller. I think, we will get people to come to office to a large extent to do collaboration work and celebration. So you will have more stand-up space, more open spaces, etc. We will also have more distributed office presence. So we will beef up some of our, presence in the outlying areas, either through leased co-working spaces or even using our own branch footprint. But when you put all of that together, I would imagine that over the next 5, 7 years, our overall real estate footprint will be a tad bit smaller than it is now.
What about your head count?
Well, I think if you look at the nature of work and the nature of jobs, that's dramatically shifting. But it's been shifting now for the last decade, 5, 7 years. And so while we've actually shed a lot of jobs, far fewer tellers and operations folk and call center operators, our overall headcount has continued to increase. And that's because we've been adding people in technology and digital and analytics, etc. So the profile of the workforce is changing. And which is why a big part of our announcement 2 days ago was this tremendous, rigorous, continued attention to reskilling the workforce. We've done about 1,000, 1,200 people in the last 2, 3 years, and we have an aggressive agenda to reskill another 7,000 people over the next 3 years. I do think also the profile of the workforce might change a little bit. I think our opportunity to bring in, categories like working moms or people who prefer working from home, I think that will improve a lot. So I think you'll see a shift in the profile of the workforce for sure.
Right, and that shift on Wall Street, after starting the pandemic with an assurance to keep jobs, we've now seen job cuts at 2, possibly 3, potentially at Citi going into next year of the big banks on Wall Street. So is that kind of restructuring something that is inevitable in this part of the world and for DBS as well?
Well, in our case, we don't expect to have a retrenchment program or a large layoff program. I think the reskilling agenda and then the natural attrition as people retire and move on, I think we'll be able to get to the workforce profile that we need. But if you ask me for the industry as a whole over the next decade, it is quite conceivable that there will be large-scale job loss across the region, and that's not impossible.